Hey, good morning. Welcome to RIA Advisors Candid Coffee. I'm Danny Ratliff here with Richard Rosso. We appreciate you guys spending your Saturday morning with us here. Candid Coffees were initially designed just during COVID, just as a way to kind of reach out, answer questions. I know a lot of people had concerns. Nobody was getting out. And we've had some good responses, so we really just want to keep these things rolling for a while. This is our spooky edition. So we're going to talk about why money doesn't have to be so scary. Rich?
I'm just glad everybody is here. Thank you so much for sitting in with us. October is a spooky month, but we don't want your money to be spooked. So we've got some good tips for you. Great questions, by the way.
Yeah, this is super informal. Like we said, just a Q&A. So kind of sitting around at the kitchen table, having some conversations here. We are Clarity Financial doing business as RIA advisors. Any of this information is not a recommendation. So please just take it as such as, friends sitting around at the kitchen table having some coffee. And, if you have further questions, don't hesitate to go to realinvestmentadvice.com. Go to ask a question. We're always happy to answer, help any way that we can. So today's agenda, perspective on volatile markets. Obviously, this is a big question we're getting from many. How to cut costs and budget. And then we're going to jump in all those questions. You guys may have actually seen a couple of them there. So Rich, let's talk about the volatility, put it in perspective, what's going on, and the secular market trend right now.
Well, you have to keep this in mind that we all say we're long-term investors until we go into a derail, and then we sort of get to panic. That's why you want to have a portfolio strategy and a portfolio plan. The reason I share this chart is not to show you that if you invested like a vampire from 1870, obviously you could have a long-term perspective. But what if you are actually invested or in retirement through those red zones? And what I wanted to show you this chart, this is a regression chart, shows you the average, and it shows you how far above the mean we happen to be. And we are the latest, again, this is a little old, September, but the latest price is 132% above trend. Now, a couple of things to be clear. That does not mean that you're going to go back to the trend, even though there's something you've all probably heard of called regression to the mean. But what I'm trying to tell you is markets are expensive, and they do these kinds of aggressive actions over time. We are not used to this, Danny, right? Over the last 12 years, we've had the Fed come in on the white horse, bail us all out, and it's been fine. But this time, the Fed's got another enemy to slay. And therefore, we're all on our own here. Sort of like out in The Walking Dead and you're out in the forest. You're on your own. So I want to help people understand that we are way above trend. And even though we've had a derail in the market, from a valuation perspective, stocks are still expensive, Danny. And we haven't really seen earnings adjustments done on the downside enough yet. So I think we're going to see a lot more in earnings compression as the Fed keeps pushing. And the Fed keeps pushing. We could be into an earnings recession. So, in my own opinion, this has just started. I think we have more downside to go. But as Lance has been writing about, he's got a great piece out there if you haven't signed up for Real Investment Advice about short selling. We should have a pretty good counter trend rally coming up. This is just another perspective, the TE10. That's the price to earnings over a rolling 10-year period. And this is from Robert Schiller. And valuations don't matter until they matter. Because when people want stocks, they don't care about valuation, right? If I want this pumpkin guy and there's a demand for him, I'm going to pay for him. I don't care how expensive he is, right? So then there comes a point, though, where valuations do matter and people start talking about it. And I think that's now one of the times. So after all the pain we've had, what I just showed you is another sort of this is more of a geometric mean. How, from a standard deviation perspective, how overdone we still are, even though, Danny, as we know, there's been a lot of damage. So even though the broad market's down roughly 24, 25%, and NASDAQ's down 30% plus, go dig deep into those indexes. And what kind of carnage do you see? There are stocks that are off 50, 60%. And let's not even talk about crypto, because that's scary. This perspective is when we build financial plans, and those of you who are sitting in that have financial plans done with us, and we've had conversations with you saying, hey, don't worry, your plan still works. That's because in 2019, what we did was we adjusted forward-looking returns for our plans to be lower on every asset class: stocks, bonds, large companies, small companies. So we front-loaded bad returns for those who are about ready to retire. So and again, I'm always a couple of years early. I will tell you, I've been doing this part of this forward-looking analysis since 2003, either up or down, and I'm always early by 2 to 4 years. And I think we're in the throes of this, Danny, where this is Lance's chart that shows you, based on valuation, your forward 10-year real returns, that's after inflation, don't look too good on stocks and bonds. That doesn't mean you're not going to have great years, but on the average, you could be in for a very sluggish period. Larry Druckenmiller, one of the best investors out there, talked about how we might have this more of a 1966 to 82 kind of scenario for markets as valuations ground down and then people didn't want stocks anymore. I don't exactly buy into that, but we have to prepare, especially retirees, for a headwind, don't we?
Yeah, I think so. But that's exactly why, like you mentioned, we factor these things into the plan so that we have a very good assumption of what is going on, how you can withstand this. And so we talked, I guess yesterday, maybe you and I on the radio show, a podcast about, hey, there are times right now where, a lot of advisors say, hey, don't worry about it. No worries. It's going to be okay. Markets come back. And that's right. But it also depends on what phase of life you're in. If you're in distribution mode, if you need these funds. That's a really easy way to manage money. You just set it and forget it. But to raise cash in this type of environment, I think is really important to have some already. We're looking to potentially raise some cash again. Like you mentioned, Rich, we see that bounce. I think that's going to provide a nice opportunity. And, many, you get people that fall on the sword of, hey, you can't stay in cash. Are saying cash is trash, everybody always says, right? No, I mean, cash can be a great place to be. And so the perspective on this is great. Now, the one thing that this is a terrible thing or terrible indicator in the sense of short term, we've had these down here. We look at PE ratios. They've been way over here in this range for quite some time. But it's been extended from the amount of time it's been here. Now, so short term, it's a terrible indicator. Long term, it's a great indicator. Now, like Rich said, this does not mean every year is going to be negative or you're going to see a 0 or 1% return, especially if we can mitigate some risk, raise some cash, and then take advantage of cheaper prices when prices get back in these ranges. I think we're going to have a nice feather in our cap when that day comes. So in the future, we're going to be looking pretty good. Now, the other caveat is that we can make arguments on stocks that you may own now that we think that, hey, these are good companies, they're paying good dividends, free cash flow looks good. That we will be able to turn around and in some period of time, not so far out, that we think they're going to be higher than where they are today. So that's the other part of why, we do get questions, Rich, of like, how come you guys aren't all the way in, or how come you're not all the way out? And it's for these types of reasons, because number one, we try to rationalize these markets, and it's very difficult.
It is. This is a tough market to navigate because what you still have out there is denial. You have denial from generations of investors, and frankly, even tenured investors who think the Fed's going to still bail them out. Frankly, we have talks in our office about what's the point where the Fed's going to bail you out. My friend Charlie Gasparino on Fox yesterday was talking about that hedge funds are worried about distress in the market, corporate bond system, and hedge funds are worried about this. That already we're starting to see distress in the financial system. So maybe, Danny, the Fed does come in and bail us out. I just don't think they can do it. And if I'm going to go from 8.5% inflation to 2, and we know 8.5% is the stated inflation, but we do a lot of study on inflation. And obviously, you've seen prices on many things that you need every day going up double digits. If you want to buy junk for the holidays, right? I want to buy toys. I need, patio furniture. Listen, you're going to get a deal. There's tremendous deals based on all the stockpiling of inventory out there. So let's talk about bonds, because everybody is worried. Because let me tell you, the 60-40 portfolio, which is 60% equity, 40% bonds, this is possibly the worst year, first of all, of my career. And I've been doing this close to 35 years. But I'm talking about, this is since probably the mid 1930s. So bonds aren't working, stocks aren't working. But let's talk about this. Think about this. Fed raises, you're holding a bullwhip and you have the handle. The Fed, see, this is my handle. So the Fed raises rates, right? That's this. The long end of this curve is really based on inflation and economic activity. I don't know, people have already seen that yield curve, multiple yield curves have inverted. Actually, it's when they start to uninvert is that when you got a problem. There's a lot of talk, there's a lot of writing that Lance puts together on this process. But as the Fed raises this also is going to change based on economic activity. So remember, what's driving the Fed side here is different than what drives here. So people go, well, what do I do with my money, right? So we have to look at one thing. You might want to guess on both sides. And we've had questions about this we'll get into. If I want the best of both worlds, Danny, in the investment world, I can roll over T-bills. I'm getting what? 3.5% yield for T-bills that are going out to maybe December, January. I could use an ETF like Bill. Yeah, I can use an ETF like Bill, right? That I'm getting 2.3, 2.4%, and it's sitting as cash. But here's what I have to think about. If I'm going into a global economic recession, where does the money go? Where does global dollar flow or global currencies flow? Where does the money come? It comes into us. It's the way it's always been. Money will come into our treasury market, but we haven't seen enough distress. We haven't seen enough acceptance of current conditions as we slowly grind into recession. And why is that? Well, the unemployment rate looks still pretty decent, although I can make an argument that post-pandemic, something is broken in the labor market. Some of the old metrics don't work. Look at the labor force participation rate. But the more distress that you get in the system and the higher prices stay, the more you're going to start to see people begrudgingly coming back into the labor force. But you see, I don't know how far the Fed has to go to get here. So think about this. If you own long duration treasuries right now, and we've had questions on this that I saw, that trade or that investment has not worked. If you believe the Fed's going to break something, it's going to work, right? I'm not going to say the word guarantee, but it's the way it's always worked. Remember, Danny, we were sitting in on a meeting with Lance and we said, what if this doesn't work? Say ultimately this long duration that we have in our portfolio doesn't work. He goes, then what did he say? And we pretty much quieted the whole room. Then something else is seriously wrong. Because then the United States is not this emerald mansion on a hill anymore. Now, we look dysfunctional to each other, but to the rest of the world, we're still looking pretty good, right? Just look at what the dollar is doing. So if I want to look at a barbell strategy, I could, if I was ambitious enough, have money in short term and long term, and hoping that well, not hoping, but thinking if economic growth is going to go down, then money will flow into my treasury yields. Yields will drop, my principal will go up. Meanwhile, I'm going to get, as the Fed keeps raising here, I'm going to keep getting higher rates on my treasury and short-term accounts at the bank, well, online banks, right? Yields you're going to get on high yield savings and so forth. So you got to be careful. You got to not be discouraged by the bonds. Eventually, they are going to work again. But we have got to unwind this, Danny. Think about the mindset that has happened since the Fed has just blanketed us with cheap money for 12 years. How tough is it to change the mindset that maybe this is more serious and the Fed is more serious? Listen, what's his Cash Carey, right? One of the Fed governors, he's been one of the most dovish Fed governors. He almost did one of those Tom Cruise jumping up and down on Oprah's couch things. We are going to raise rates. Are you guys listening? In other words, the Fed has been trying to convince markets they're not pivoting anytime soon. Longer term, this is good. Longer term, this is a cleansing of the system. It gets the malinvestment, it gets the distortion in prices and asset classes out. And what did Lance and we all talk about, Danny? We finally can go back to analyzing investments like we did in the past. Looking at balance sheets, looking at free cash flow, looking at dividends, and not all this cheap money that distorts the system. So even though in the short term it looks bad, in the long term, it's a healthy situation. If the Fed yet doesn't come in and bail us out, I think the jury's still out. I don't think they can.
Well, I think they will, but what does that show exactly when they make that big pivot? They're going to come in and bail us out at some point, right? Because we can't continue to fight it. Inflation is not going to matter if there's financial instability all over the world, and we have, credit issues. Then we have much bigger issues, I think, than what we see right now. And inflation won't matter at all.
No, by the end of next year, you know what's going to happen. By the end of next year, if we're in recession by the middle of the year of next year, then the Fed's going to have to, they're raising rates, are going to have to lower them again, right? And to your point, to lower distress, listen, the ECB, was it the ECB that went? No, or was it with the Bank of England that went in and bought bonds again?
Yeah, Bank of England bought bonds, but they saw currency drop by 10% overnight on Sunday night. You wake up Monday morning. I mean, Look, there's a lot of distress out there. And, we didn't know what was going on at the time, but now we know that there are many pension funds that were struggling. They were having trouble making ends meet because of the quick change in currency. So that's something that I think that we're seeing things breaking down behind the scenes. And so,
already.
So that's why we do. Yeah,
that's right. They just haven't gotten on to mainstream yet, but yes, we are starting to see. So imagine the Fed funds rate at 4.5%, Danny. Imagine mortgage rates.
That's what their target is. Their target's 4.4.
I know. But think about based on where we've been, what kind of devastation they're going to cause for high yield markets, possibly corporate markets, indebted corporations, zombie companies. I mean, go ahead and name it. Households that live on low interest rates. Lawrence Yu, who's the chief economist of the HAR, right? Saying, hey, housing is already in recession. No, the National Association of Realtors, I'm sorry. He was saying that, hey, we're already in recession in the housing market. So, yeah. This is going to be a test for the textbooks, by the way, because with the amount of debt we have in our system overall, I think our debt service, our interest on the debt is going to be annually over like $1.06 trillion based on what we've seen so far. Something is going to break and the Fed is going to break it. And that means long-term treasuries are going to work. It just hasn't worked yet.
Bank of England's capitulated. I know they're saying it's temporary. You're going to see other capitulation by other major central banks. It's going to be the domino effect. And if you get that credit issue, that's where, I think you see them do quicker than what we expect. Now, with that being said, I think what you mentioned is, I'm telling people, look, we're very optimistic in a lot of ways. I mean, number one, we're sitting on a lot of cash. Number two, or cash alternative. I believe that, those things like you mentioned, the balance sheets, the fundamentals, those are going to mean something again. And we're going to be able to go in and pick up these companies that we've liked. They've just been way too darn expensive to go buy and buy them at much, much better prices. That's what gets me excited. And knowing that, look, I think there's going to be that opportunity that it doesn't come every day. And you get back when you cleanse the market, we can get back to the basics.
No, we can. And, Lance's premise, and I agree with it, and Michael's based on the study of history that we do. And we do all of this in-house, by the way, for those of you who are sitting in on this and don't understand our operation. We purchase an amount of data, but everything we do is in-house. And we crunch all our own numbers. If Lance and Michael are right, then these yields on these longer duration treasuries will go to zero. Those unprofitable investments will turn profitable, but that would be just at the time we would be selling those and going into stocks when people will be going, how in heck are you buying stocks? Don't do that. We're not there yet.
Yeah.
This process is taking a bit longer than we anticipated, and I do think it's because of post-pandemic situation. So cash is not trash. I've done a lot of interviews with various news stations about this. You hear a lot of financial advisors talk about, but cash is going to lose to inflation. Oh my gosh. Well, listen, when markets are rough, you're going to fall on one sword or another. You're going to fall on the inflation sword or the loss of principal sword. I'm going to fall on the inflation sword only because I'm not keeping the cash there forever. But for some people, especially the clients we work with who are retired, cash is a bucket for distributions, right? Everything dumps into the bucket and then people create their retirement income from that. But it is an asset class. Today, Danny, more than ever, as bonds and stocks sort of move together, cash is a true diversifier, right? It has little or no correlation with any other asset class, right? Cash has a 0.2 historical correlation to the S&P. They're not connected by a volatility strength. It's an anchor in a market and an economic storm. It is not a long-term substitute for investments, but Wall Street has to have every one of your dollars in the stock market. Even though they may hold a lot of cash in their institutional accounts, they have to have every your dollars into the stock market. It's ridiculous. And for the first time in a long time, cash is actually earning a little something while you wait. So cash is not trash. You all that want your cash, we'll take it. Erica, I know will take it. So keep in mind, every weekend we post our newsletter. That's number one. And the newsletter is really a great resource. Now, for some people, it's a bit too much, and they have a problem with the intensity of it. I call it the intensity of the newsletter. But believe me, you also get a daily commentary from Lance. You can sign up for that. But just read the blog. The pieces along the week, the incredible writing along the week that Danny and Lance do, and I do as well. But my topics are more on things that affect you most of the time outside of the portfolio, including Medicare and Social Security and other topics that are important as well.
Hey, but this is a great question, sure, Rich, because how many questions do we get on this? Like, where do you park cash? What do you do? And, for once, cash is actually paying you a little bit, which is actually nice. However, we know it's not keeping up with inflation. So we're encouraging lots of people to look for other areas, like go outside your traditional bank. Your brick and mortar bank doesn't want you anymore. They're trying to push you online as it is. Go find a bank that's going to actually pay you to park cash if you're going to do so. And what do we tell people with this, Rich? It needs to be emergency funds, financial vulnerability cushion, or if you have an objective, a goal that you're going to use these funds for very quickly, that's where we want to park these funds in some place like that. Now, you can, like this next one says, investigate T-bills. Look, the 3-month T-bill is paying you 3.25. On a 6-month, you're getting 3.9 right now. So if you said, listen, I don't need to pay, I'm saving money for my taxes, for whatever it may be, you can actually park money very strategically and start to get paid a heck of a lot more than what you've been doing. We do like, Nerd Wallet, Bank Rate. You can go and actually just Google high yield savings. That's a really good resource where they aggregate all these different banks.
Nerd Wallet does a good job analyzing those things as well.
And so Rich and I, usually what we'll do is he'll use certain banks, I'll use other banks. And that way we get some experience with them. We can tell you guys what's good and bad about them.
Yeah.
Some don't have the best applications. Some are better with, communications than others. So those are all things that I think that are important. But number one, make sure you set it up correctly where you're FDIC insured.
The average account interest rate at commercial banks is 0.13%. Banks don't want your cash. They're sitting on trillions of cash. They don't want your cash. They want you to take out loans. Years ago, if you would remember, the federal funds rate would go up, and then banks would immediately raise their rates on savings. They don't do it anymore. So if you're making an assumption that your brick and mortar bank is increasing the rates on savings accounts, you are wrong. You're wrong. Okay, this is from Ken Tuman. This is the actual, I just pulled this a week ago, 0.13%. Look at a high yield savings from online banks. They also have checking accounts. And no, Danny and I are not paid by online banks.
Not at all. So we talked about, where do you park cash? How does bonds work right now? A little bit about the volatility of the markets, but what about the other ideas, Rich, on the other side of the balance sheet and the things that a lot of people don't think about this, but the budgeting, how do you keep more money in your pocket just from, your behaviors, things that you do?
Well, I think people have, obviously when you see the recent studies from out of the Fed household survey and many other surveys that are out there, you're seeing that people are changing their spending habits, and they are switching to generic brands, and they're doing what they can. But if you got to think somewhat bigger sometimes, because now we got to go to level 2 of this budget. And level 2 is also, if you're 65 and older, you need to make sure you're going in on open enrollment and investigating your Part D prescription drug plan. You very well could be overpaying. So spend 30 or 40 minutes at Medicare.gov and go through it. Have your drugs with you, go through, compare your current plan to a new plan. Okay. There could be less pressure on these Part D plans because of the some of the changes in the Inflation Reduction Act. It's hard for me to say that. So just keep this in mind, that that's a big thing that you can do as an older American. To Danny's point, the full financial vulnerability cushion can be taken to the next level. Financial vulnerability assessment. I have clients that have distressed cash budgets, and Danny, they've been working with us to say, hey, I think I'm paying too much on my auto insurance or property and casualty insurance. They don't want to understand, or they don't have an umbrella coverage on their home, right? Because their net worth could be attacked. Because if other people are going through rough times, and God forbid something happens, you might be the one who pays for it. So you have to look at mitigation of risk as part of your thinking big, whether it's to save money on insurance, whether it's ironically boosting your insurance coverage because your household budget's shaky and you don't want to be hit by some unforeseen situation that can ruin you possibly. Obviously, this is a no-brainer. I have a feeling everybody who's sitting in on this morning, if they spent the time on a beautiful morning to sit with us, they have very little, if any, unsecured debts. That's credit card debt, anything that has a floating rate to it. If you have your relatives, your children, your grandchildren, that they keep a balance on their cards, please pay it off. This is coming up. Now, also, if your mortgage rate is higher than 4% and you're going to be in your home for a longer period, say 10 years, it's time to accelerate the pay down on that. And I'm gonna say this here, Danny. Mr. Pumpkin is going to hold me to it. You are going to have another chance. If you have a mortgage that's higher than 4%, you will have another chance to refinance. Because let me help you understand this one big picture thing. We're not having any babies globally. You know why you're sitting here with us today, this morning? Because you're not having babies, okay? The demographics are very poor across the world. Lack of the poor demographics is a deflationary situation more than inflationary. So if you look at inflation expectations over the next 5 years, they're back down, aren't they, Danny? I think they're back down to, say, 2.5. There are bigger structural issues going on, and I printed this paper out yesterday at the office, and I forgot it there. But it's a new study by the Atlanta Fed about demographics and deflation that I wanted to read. So keep in mind, you will have another chance to refinance. Now, if you've done a good job at refinancing at 2.5%, 3%, no, but you will have another chance. So these are just bigger picture. Auto subscription. If you haven't gone through, I don't do anything on a recurring annual, hey, you got to renew your Norton antivirus. Okay, well, send me the email when you look at it, and then I don't want anything that is going to escape me. So go through your statements to make sure that you're cutting off all auto subscriptions. I've had people, Danny, save thousands of dollars. They've been paying for like what I call phantom auto subscriptions, where they don't even have the product anymore, or they don't even own them, and they're still paying for years. These are kinds of things you have to put a handle on right now and cut. Like Jason Voorhees. Gosh, where's my machete? I have one. I gotta get one of those. So
but you know what, Rich? I think a lot of times there's a lot of subscription that people think, oh, well, this helps me with work, or it's like the Wall Street Journal or a gym membership. They say I can't get rid of this, but they don't ever use it, right? So sometimes we have to just get real with ourselves and say, hey guys, listen, I mean, you kind of have to have that internal clock that says, this doesn't make sense. Get rid of it. And I know some of you guys are really good at it, but some people,
I would think everybody on this lunch and learn are really good at it. But you have children and grandchildren and friends who are not, and let them know. And if you're going to cancel the gym membership, I'm going to tell you one thing: don't. Health equals wealth. Take up the gym. And don't have candy corn.
All right, guys. Hey,
someone had candy corn for breakfast. I'm not going to say who. Erica. Oh, we're going to
I want to give away a mug today. So Lori LaCour, we're going to send you a mug if you would. If you'd send in your information to us, that'd be great. Erica can coordinate with you. Yeah, so Candid coffee mug. We appreciate you guys being on this morning. We're going to give away one more mug, so don't go away.
Let's give one more mug.
Questions coming.
We're going to give one more mug.
All right. All right.
On.
So Randy Bennett. We'll do one more right now. Randy Bennett, we're going to get you a mug. You guys keep asking questions.
Okay, give away 3 mugs. We're going to give away 3 mugs. Boriana. So I have to get your name. 3 mugs. You're going to have to get with Erica so she can send those to you.
All right.
Yay. Woohoo. So I want to give you some books with the B word. Some are going to be good for your kids, some for you. But The Ultimate Guide to Frugal Living, Save Money, Plan Ahead, Live Well, Paperback. Really cool book. I will tell you, it's got a lot of simple ideas. Budgeting doesn't have to suck. This is really for young adults and teens. I had Haley use this, my daughter. At one point, we went through budgeting. And just a simple simplified home budget book. Dome books have been around almost as long as Brent Clanton, our producer, and that's a long time. So keep in mind that we are readers. I did not put out my reading list this year, but man, I'm reading away on a lot of great books, which I will post the beginning of January. I'm going to post my 10 favorite books for you to read that you probably haven't read yet. So, but these are just some simple ideas. That's all we got for the presentation. We just wanted to make sure we covered some things with you and that we can get to some of your questions.
Yeah. Hey, and Rich, I think one more book that we talked about actually yesterday on Financial Fitness Friday was The Millionaire Next Door. I mean, what a great book.
Amazing
just to get the mindset right. We talked about money scripts, how important that is within, understanding the psychological behaviors that we all have that typically were ingrained during childhood or through other experiences. So that's a great book. I encourage everybody to read.
Millionaire Next Door, is the book.
Especially kids. If you want to, if you had a book for a college graduate, great gift. Something I think that everybody would really enjoy. So we are going to jump into those questions. Now, the slides that we put together, historically, we don't put together slides. We kind of just jump in. We do a little bit here and there, but those were really based around a lot of questions we've received already. And so we do have quite a few still. Now, Rich, there's a lot of questions about, what are thoughts on T-bills, notes versus CDs, and what do we think about durations? This is kind of going back to the slide previously.
You know what? You're like a kid in a candy store right now with short-term yields. I mean, I'm like giddy. My grandmother used to shop CDs and then have to physically go to the bank and nudge everybody. It's like, go to the newspaper. Ooh, look at that, the yield is 6%. And go, and then she'd be going all day. She would drag me to the bank. I'll never forget it. I'm like, oh my gosh, this is the bank day all day. You now have online to do this, but I will tell you, short-term cash in an online bank is amazing. I'm having trouble locking up CD money only because the Fed is going to continue to raise rates. I wouldn't go out any further than 3 to 6 months because I want to have the ability to rotate that. Not that I have anything wrong with these CDs. And there's some great CDs, say from Synchrony and all that I think they have CDs where they give you one time where you can ratchet it up. In other words, I think it's a 2-year, but I think what they'll say is you have one time to say, now when yields go up, you can increase it. So there are some CD products that you might have the ability to go ahead and, even though you're locked up for a couple of years, you might have the ability to raise rates for that. Sometimes T-bills are going to be a pain in the neck for people to buy, through Treasury Direct. You can do it. I-bonds are still good. Just keep in mind, I-bonds, they're paying attractive rates now. You can do $10,000 per person, but keep this keep this in mind that you're going to hold these for probably 5 years. And as they start to roll over the next 4 to 5 years, you're going to be disappointed with the rates. You'll still get the CPI rate. So if you want something that's always going to keep up with inflation, I-bonds are going to do it. but don't expect these 9, 8% yields to last. That's not going to happen. Now, people have been asking about high yield CDs. I mean, high yield ETFs and all that. I want to tell you one thing. Personally, I'm not going to be seduced by yield in a market that's about to be financially distressed. I do not want to own this. We won't own high yield in this market. Okay. As rates go up, these companies that are highly leveraged are going to be pressured. I want the highest quality debt. You can look at corporate debt, but be very careful. Someone asked a question about bullet shares. And what bullet shares are a pretty interesting concept from Invesco, where they'll buy laddered bonds, and you'll buy a 2022, a 2023 ETF, 2024. But keep in mind, your ETF doesn't really mature. Inside, those bonds will get closer to being, they'll roll it into cash. So like the 2022, for example, you'll have less downside risk. But I will tell you, the yields on those are not that good compared to Treasuries. There's nothing wrong with them. They've held up pretty well compared to, say, longer duration ETFs and all that. So there's nothing wrong if you wanted to ladder out some of those, but understand they do not work like regular bonds. You may or may not get your principal back. Most likely you're not. But the 2022, I think, has a yield of like 1.6%. But the downside risk has been even less than some of the Treasury ETFs. So you got to put together a fixed income strategy that works for you. The problem is, for some, you have all these choices, Danny. There's just like so much that you can do. But I would, as the economy gets worse, and we've had zombie companies walking around for years, I wouldn't own anything that's but the highest quality going into an economic contraction. What do you think?
Yeah, absolutely not. I mean, so look, if you do think that right now we're peaking and that everything's about to fall apart, longer duration is probably not a terrible thing if you want to go out and buy those individual Treasury bonds. But
well, you can get a 2-year Treasury. If you want to lock up money for 2-year Treasuries, you're going to get over 4%. But, so if you're happy with that for part of your overall portfolio, I would rather you own a Treasury, because a comparable corporate high grade is not going to give you much more than that. And I'm taking credit risk. I mean, triple B is still investment grade, but I will tell you, if there's financial distress in the system, you might get a little nervous. So why not go for something that's 100% guaranteed in the US Treasury market? It's not like I'm going to get a 2-year Treasury at 4% and I'm going to get a high grade corporate at 6. Okay. Now I might get a high yield at 6 or 7, but why do I want to take the risk to my principal? Don't be seduced by yield. I have people sending me emails with all these different symbols, and I'm looking them up and I'm like, oh my God, these got 10, 11, 12% yields. Then I'm looking inside some of the balance sheets on these things and I look at all the leverage they have. I don't want that going into an economic contraction. I want my money as safe as I possibly can, especially on the fixed income side. If I'm buying individual fixed income, I don't want to lose sleep over my fixed income. Now, if I'm coming out of an economic contraction, right? I'm coming out and I see which companies I've made it through, and then I want to look at high yield, sure. But I just think that you've got to be as safe as possible. Create your barbell strategy. Use a foundation of Treasuries or I bonds or high yield FDIC insured savings and CDs, and I think you're going to be perfectly fine. But build in there, Danny, flexibility as the Fed's raising rates here. Because remember, what should happen eventually as the denial goes away and the Fed doesn't ride in on the white horse, these yields go up, these longer intermediate term yields go down.
So keep in mind with the I bonds in particular, you do have to hold those for at least 1 year. If you sell them prior to 5 years, like Rich was mentioning, then you forfeit 3 months interest. So it's not the end of the world, but certainly a strategy where I wouldn't anticipate in this environment holding them for a full 5 years. I think that we'd be getting rid of those much quicker. But I think that, hey, it's a great investment for the next couple, year, maybe 2 years, while if we see inflation rather persistent. Now, here's the thing that I want everybody to keep in mind, that we want to back into these numbers. We don't want to just throw everything we have into something like this. We want to say, okay, we have X amount of money. We can put this much here. Now, you can't put a ton of money into these types of investments. It's $10,000 a year per person. If you get a tax return, you can go buy physical paper I bonds at up to $5,000. But you can also do a gift box strategy where, like for your spouse, you can gift them. You can buy some for them, but then you don't actually physically give it to them until a year that they don't actually go buy more, which I would anticipate in the next year or two, that probably won't happen. So certainly some strategies around this that you guys could utilize to try to, get a little bit higher yield. I don't think that's a bad thing. One thing that I think Rich is honing in on, though, is that we want to be rather nimble in this environment because we think that we're going to have a really nice buying opportunity. We think that long duration bonds are going to be a really nice buying opportunity, but equities as well further down the road.
Well, Jeffrey Gundlach has a great report out there. If you look him up, he's the bond king. He says Treasuries are the best deal out there right now. I always respect what Jeffrey Gundlach has to say. Now, someone asked about hedging strategies, and I want to tell you this: cash is one of the best hedges you're going to have. And I don't want to have to worry about making a bonehead move. Right now, markets are so oversold that I think shorting might be riskier than not. Like, there are a lot of ETFs out there that we'll even use to short the market, but we're not going to buy them here, right? Because look at what is Lance's piece that came out a few days ago? The mother of all short-term rallies is coming. If you think that there's another leg down and there's going to be this sort of counter trend rally, right? During the counter trend rally is when I would add the short. If I think I'm going to do like a bear market where I'm going to retrace and then I'm going to take that next leg down, that's when I want to own the hedge. I don't want to own the hedge here. There are more people that are just, they're in the bunker right now when it comes to investor sentiment, right? They're not sort of doing it with some of their cash, but right now, when you look at Lance's technicals, and I'm sure it'll be in his newsletter this morning, that you are so much oversold at this point that you're going to get a bounce. It's on that bounce that you add a hedge. That it's not here. My hedge here is cash, just as a thought, right, Danny? We will add a short position for a certain percentage, but we wouldn't do it here. We want to do it when you are in this incredible bounce. If you're thinking we're taking another leg down, to me, it seems like this is the kind of bear market cycle you're in, and that's how bear markets work. I always have this old adage, Danny, corrections fall off cliffs, bear markets roll downhill. That's my own analogy. You can copyright it. Yes, you get corrections through bear markets, and you get great up moves during bear markets, but you get a lot of this stair stepping, right? You 50% retrace. At that 50% retracement, generally speaking, where we are, you should have continued higher based on how the prior month did. There's some studies out there that show that, and that didn't work. So in other words, now what will happen is you've lost that retracement. Now what should happen, you should take another leg up, not fully recover, and then take that final capitulation leg down. And then, you've rolled down the hill and then you hit the cliff. So we're in this phase right now, like the third leg of this cycle here. And I don't even know where I was going with this because I'm rambling on right now. But the point I'm trying to make is there's a better time for you to add a store or hedge than you do now. Actually, what we're thinking, like we own a little bit, not that it's a hedge, Danny, but sometimes you got to think a little bit contrarian during periods like this. The dollar is screaming higher. We own a little bit of the euro, the FXE here, thinking that this is going to be currency manipulation. This can't last with the dollar being this strong. It is not good for the rest of the world. So, we do own a little bit of a contrarian play. So there's a difference than a hedge versus a contrarian kind of trade. What else?
Yeah, look, and the Fed's having an emergency meeting on Monday. I mean, who knows what comes out of this?
No.
Yeah. So I don't think we see that capitulation quite yet, but it's going to be interesting to see what happens here. So we're getting a lot of questions on, okay, how do you guys work with people? What does an onboarding process look like? And it's much different than most firms.
Go ahead,
Number one,
Go ahead.
Yeah, we can talk a little bit about logistics of that. Typically what we do is we have somebody send their statements in, we take a look at this and we say, okay, what is, where do you have your assets? How does this look? We would open accounts that are very similar at a custodian or potentially have, if you're already using a custodian we work with, utilize the accounts that you already have. But from there, I think the bigger question surrounding this is, do you just put everything directly into the model? And the answer is no. So we have a lot of clients that have been bringing assets in where we've been waiting for that moment where we feel like there's a better opportunity to maybe make a transition towards our portfolio or our model from what they currently have. We also look at, what are tax ramifications? What does that look like? You may own some positions that are very similar to the positions that we own, that we like, that we can say, hey, we'll map that towards it. But let's say you come in cash. Cash is a very slow process right now. So, what we're looking to do is as interest rates bounce around, we've seen yields pop a bit. We like to look at short duration. And I think that, short duration ETFs, like Rich mentioned earlier, looking at T-bills, that can be some opportunity there. And then, money market's not as bad as it used to be. We are getting paid a little bit in that area as well. So those are what we're watching for and kind of what we're looking at the moment. So we want to make sure that when we look at all of the, take the big picture. So we're also looking in the background, you're working on your financial plan, which over time we're building that out. We're understanding how that works and what the big picture looks like with the overall plan. So the plan gives us a lot of different information, and it gives us a lot of information that, we can help you guys with the things we just talked about in the sense of saving money. How do you save more money, keep more money in your pocket, looking at outside assets as well. And so I hope that's a kind of a long-winded answer there, but gives you a little bit of an idea as far as what that looks like. Another question we get is, are you familiar with thrift savings plans or government plans? And yes, we are. We do have a lot of government employees who've retired, looked at their pensions, their thrift savings plans. Those are things that we work with regularly, just like any other types of accounts. All right, so do interest rates on Treasuries always rise as the Fed raises interest rates?
Generally. I mean, what doesn't happen is commercial banks don't raise their rates, but generally speaking, auctions should be higher, right? You should see higher yields on short-term Treasuries as the Fed does it, overall. When do we think the shift into Treasuries will occur? Gosh, darn it, Stephen, I don't know. It's taken longer than I thought it would. I think there's just so much denial about where this economy is going and that the Fed's going to bail us out. Is like this strange game of chicken between the economy and the market and the Fed. I mean, we keep using the P word for pivot, and then that went away. I mean, you could see the distress on Powell's face, like after his comments, that people got the word pivot out of that. I mean, that's all hope.
Yeah.
That's all hope and denial that eventually has to drain out of here. Once that starts to happen, you've got 12 years of conditioning of people to think the Fed's going to come in and bail them out. So once that conditioning dries up, then the fear will drive money into Treasuries. That's just the way it's always worked, and I can't imagine it wouldn't work now. But it's taken it's taken a lot longer because I think it's I'll tell you what I think it is, Danny, and this is everyone. I think this is my own opinion. The pandemic, the lockdown, it all screwed everything up, right? So these post-pandemic behaviors don't fit into anything. It's strange. So I think it's affecting how this process is playing out right now and how these numbers look, Danny. Especially in the labor market. In other words, the Fed's really concerned about this wage price spiral, right? They're really concerned that wages have to keep going up, and then prices are going to keep going up, and wages are very sticky. If you look at the Atlanta Fed sticky price index, that hasn't budged. This is what the Fed's concerned about. So I don't know how much pressure they're going to have to do on the short end to go ahead and blow it up. But and there's no talk about how much economic pain they're going to have to inflict to get to 2% on inflation. And that's the dilemma I think we're in. It's this labor force participation rate and this need for workers on one end, but you're going to start to see layoffs. I think this is a white collar middle management layoff situation coming, Danny. If you're working at Lowe's in the seasonal aisle, I don't think you're going to lose your job. I think it's more on the managerial side, and these are going to come, but because of the labor force participation rate being where it is, and people that have disappeared from the workforce, it's created this situation, this game of chicken between the Fed, how much pain they can inflict before they start seeing unemployment go higher. What did Larry Summers say? We need to see unemployment at what, 6.5%.
That's going to be difficult
before the Fed's done. Yeah.
Yeah. So we are seeing things occur that are confirming that trend in the sense of, we saw Ford lay off 3,000 execs, middle management and up. We've seen Gap do the same thing just as of last week, laid off 10% of their workforce in their headquarters. But we're also seeing, you mentioned seasonal jobs. We're seeing a lot of companies who are saying the number of seasonal employees that we're going to hire this holiday season is not going to be nearly as much as what we'd expected. So hey, a couple minutes left, Rich. Let's jump through and kind of answer a couple things. So rumor is the dollar will collapse. The new money will be gold back. Now, this is a question you and I get quite a bit. So maybe address that very quickly. Got to remember how much gold in the world there is, how much valuation there'd be to a currency with it. There's no way it could support the global economy.
It's a nice romantic gesture. I just don't think that it's going to happen. I just think that you want to read a really good book about this. She's sort of disappeared. Ellen Hodgson Brown is an author and attorney. She wrote a book called Web of Debt. And she talks about what happened when there was a gold backing the system. Do you know The Wizard of Oz was based on the gold standard?
Hey, man.
All right. So
I hang around you long enough. You learn a thing or two, right?
I want to just say that there's not enough gold. And there's where you get the haves and the have-nots, really more than anything else, because whoever owns the gold owns the world. And there's this stock. And even though this fiat currency issue is not going to go away, it's based on, and again, I get how people feel about it, because it's based on faith and confidence in the country that issues it. And there are a lot of people in the United States that are not confident in the direction of where we're going. Probably the worst it's been when you look at polls. So I understand this rationale for it, but it's just not functional. I just can't see it happening. I just don't.
All right, a couple questions left. So will the Fed ever mix its message, lower rates but keep some QT? I think anything's possible at this point.
I think it's possible. I mean, they'll do it. Yeah. Will they mix it up? Sure.
Well, look at
Dr. Frankenstein. He had all these different parts, right? Dr. Frankenstein had all these different parts, right? He put them all together. Look what he created. That's what Bernanke created. Bernanke's like Dr.
Bank of England just did exactly that, Rich. I mean, they just raised interest rates, and now they switched from QT to QE, where they're actually buying bonds. So
it's good. It could absolutely happen here. That might be a good question for just that question, which is very good. I would send that to Michael Leibowitz too. Let him talk about it Thursday on the show, because I do think that's a great question.
Yeah, absolutely.
To Michael.
Okay, so here's a question we get often: is that what are the things that may break the market or the economy and cause that Lehman event where the Fed does change policy? And maybe we don't have that event, but usually we get in these types of environments. We talk about when the tide goes out, you see who's swimming naked. Well, I mean, that may be what happens here, where we see who's got a little bit too much debt. We're watching CDS right now. I think there's a lot of potential holes out there, and there's only enough fingers to plug that dam at some point. I don't know what it is. If we did, we'd be, shorting exactly that. I think that's what everybody would be doing. What do you think, Rich?
I will tell you, just like what I mentioned, what Charlie Gasparino said, that you have a lot of Wall Street firms that are already talking about issues with this kind of thing that you're talking about. There's going to be some sort of break in the financial system already. They're worried about it just based on where rates are. So yes, something is going to give. Based on how much debt we have in the system, we just don't know when. That would also cause 10-year longer duration Treasury yields to drop.
Okay, Rich, I know we did get a question on bullet shares. You want to address that? We've got 1 minute.
Well, again, we talked about the bullet shares earlier. I mean, I think that the bullet shares are fine, but don't think of them as individual bonds. There's individual bonds that mature within, but that doesn't mean you won't go through loss of principal. When I look at the yields on bullet shares, I still think that I can get better yields by owning T-bills and not have to worry about all that junk. I just do. I mean, like, what's good about the bullet shares is you're not seeing as much loss of principal compared to more of the standard ETFs out there, right? You're not seeing that across the board. That's positive. But if I'm going to take that step and I have lower yield, why don't I just go and buy Bill or something like that that's going to give me a higher yield and I don't have to worry about it.
Right.
And they're corporate bonds, and again, what I'm trying to help everybody understand is with the psychology of this. If I'm going into an economic contraction, I want to overweight treasuries and high quality over even corporates. I want to overweight treasuries over everything else.
Last question: are the banks okay? I think they're much better situated than they were prior to the Great Recession.
Yeah, I don't see that.
But,
I don't see the mortgage rate crisis or anything else. But go ahead.
Yeah, the banks that scare us the most are probably overseas banks at the moment, where they've got a little bit more systemic risk and contagion factor. But I think they're much healthier. Balance sheets look a lot better. But that doesn't mean that you see something with systemic risk that this could get much worse. Hey guys, we're right at an hour. We appreciate all the questions. If you have something we didn't get to, you'd like us to answer, go to realinvestmentadvice.com. Go to ask a question. Shoot Rich an email. Shoot myself an email. We're going to try to do these once a month.
Last Saturday of the month. We're going to start in January. So we'll be doing these more on a regular basis, everybody. Yeah. So keep that in mind.
Go check out the podcast. Go to YouTube. Go like that. We're going to keep doing this like Rich said. We appreciate you guys. And go listen. Go watch. realinvestmentadvice.com, AM 700 if you are in Houston. And go look at the newsletter if you haven't signed up already. Thank y'all. Have a great weekend. We'll see you guys next week.